Take a quick look at the stock market right now. You can see the Dow is down 918 points, but the more important thing to look at is the percentage. It's down, you can see 3.16%. S&P is down just a little bit more, 3.2%, and the NASDAQ is down about 3 1/3%.
Of course, we've been talking about the economic impact of the coronavirus and what it's having here and around the world. Joining us is financial analyst Dennis Brewster. And Dennis, you know, most of us, we look at the stock market, we know we've got a 401k out there, and we're worried about whether or not that's going to be healthy for us.
Sure.
We see something like this, what's the reaction that should take place?
Well, you want to, the declines were always dramatic. No matter how many times you've been through them, no matter how many times you've seen them, it's always unnerving to see the market down 1,000 points this morning. But you also want to make sure don't overreact to this. Don't let the short-term events change or dictate your longer-term plans.
And now we're still quite a ways away from what would be considered a level 1 halt, where the S&P drops 7% and then they stop trading for 15 minutes if it's before 3:25 Eastern time.
Sure.
Can you talk about, we keep saying, oh, coronavirus, this is affecting the markets. Can you connect the dots for folks as to how that works and why it's such a concern?
Right. It's a couple factors in play. Number one, the market's been up 25–30% over the last year. So you've got an environment that was ripe for a decline. On top of that, it's a real, obviously it's a health issue and a bad one at that, but it's having an economic effect. The tough part is how much, because we don't know when that virus is completely going to be contained. So you do have a lot of disruption, especially in Asia. Companies like Apple that both sell to Asia and get products, there's going to be some real disruptions. The hard part is how much, and the market always hates uncertainty. So we'll get through it, but in the short run, it's going to be a bumpy ride.
Again, I get back to the average investor. I think most of us are passive when it comes to the investments we have in the stock market. Who are the people that are causing it to shift and pulling their money out, putting it into safer havens?
Right. Well, markets are made up of a huge number of participants. So you've got a lot of people, maybe like ourselves, that are saving on a regular basis for retirement, that don't worry so much about the ups and downs in the short run. But on the other hand, you've also got a large pool of investors that are constantly trading the ups and downs back and forth. And so everybody knew that this market, sooner or later, we can't keep going up forever. And so they have much shorter horizons. So when they get an event like this, they know, you know what, I'm out. I'll let the dust settle, I'll wait, I'll come back. And that's why you get these short-term gyrations.
Dennis, you are the voice of reason. The big takeaway today is don't panic. Don't do anything. Over the long term, the market always comes out ahead, but you got to weather these storms now and again.
Easier said than done.
I know.
You're right on the money.
Just don't look. All right.
Thank
Dennis
you.
Brewster, thank you so much.
It's very calm. I was looking for a little sweat or something on the forehead.
Nothing. He is cool as a cucumber.
He's under control, yeah.